Tesla Q1 2026 Earnings Call Summary. This is a detailed summary of Tesla's Q1 2026 earnings call, focusing on key financial metrics, management's outlook, risks, and important statements from the CEO and CFO. Overall financial performance, as presented in the transcript. While the transcript focuses heavily on future plans and technology updates, it does provide some insights into the financial state of the company. Specific revenue and profit figures for Q1 2026 are not explicitly stated in this excerpt. However, we can infer the following. Revenue. The transcript implies a strong order backlog and increasing demand in certain regions, EMEA, APAC, suggesting positive revenue trends for the auto business. The energy storage business experienced a sequential decline in deployments, but overall 2026 deployments are expected to be higher than 2025. Profit/margins. Auto margins, excluding credits, improved sequentially from 17.9% to 19.2%. This was bolstered by one-time benefits from warranty true-downs, $230 million, and some tariff relief. Energy storage margins exceeded 39.5% due to over $250 million in one-time tariff recognition benefits. However, normalized margins are expected to see compression due to competition and tariff impacts. Services and others improved sequentially from 8.8% to 9.2%. Capital expenditures. CapEx. The company is entering a significant investment phase, with expectations of over $25 billion in CapEx for 2026. This is driven by the construction and operation of 6 new factories, as well as increased investment in AI initiatives and infrastructure. Free cash flow, SCF, ended the quarter with just over $1.4 billion. The significant CapEx planned for 2026 will likely lead to negative free cash flow for the remainder of the year. Management's forecasts and future outlook. Tesla has an ambitious roadmap for the coming quarters and years, with a heavy emphasis on technological advancement and production scaling. 2026 as a year of investment. CEO Elon Musk emphasized that 2026 will be characterized by substantially increasing our investments in the future, leading to a significant rise in CapEx. This is seen as well justified for a substantially increased future revenue stream. Core technology advancements. Investments are focused on improving battery technology, powertrain, AI software, AI training, chip design, and manufacturing processes to lay the groundwork for increased production. Supply chain strengthening. The company is bolstering its supply chain across batteries, energy, AI, and silicon. Optimus humanoid robot. Release. Optimus V3 design is nearing completion and is expected to be showcased around mid-2026. Production start. Initial production is anticipated around late July or August of 2026, with Fremont preparing for starter production later in the year. A second Optimus factory at Giga, Texas is expected to begin production around summer 2027. Production rate. Initial production is expected to be very slow due to the complexity of a new product and supply chain, with production ramping up exponentially towards the end of 2026 and into 2027. Predicting a specific rate for 2026 exiting the year is deemed impossible due to the inherent challenges of scaling a completely new product. Initial skills will be basic, starting with factory tasks and then expanding. Significance. Musk reiterated his belief that Optimus will be Tesla's biggest product, not just Tesla's biggest product ever, but probably the biggest product ever. Vehicle production. Production of all vehicles and at all factories will be ramped up throughout the remainder of 2026. Cybercab and semi-truck. Production has begun for Cybercab and will commence soon for semi-truck. Both are expected to follow an S-curve ramp-up, starting slow and accelerating towards the end of the year. Autonomous vehicles. The company believes most long-term production will be Cybercab, as 90% of miles driven are by 1 or 2 people. The entire lineup is expected to become autonomous vehicles of different sizes, with only the new Tesla Roadster being manually driven long-term. Energy front, Megapack. Demand is strong, and production of Megapack 3 is set to begin later in 2026 at the new factory outside Houston. Solar. While the residential solar market is undergoing a correction, demand is expected to pick up in the second half of 2026. Tesla has introduced a lease product and a new, superior solar panel. Global solar and storage markets at both residential and utility scales are expected to continue growing. Full self-driving, FSD, and robotaxi, unsupervised FSD, version 14.3 is considered the last piece of the puzzle for unsupervised FSD. However, the company will wait for further software improvements, like V15, to enhance safety before a very large-scale deployment. Robotaxi expansion. The company hopes to have unsupervised FSD or robotaxi operating in a dozen states by the end of this year. The expansion is cautious due to a strong focus on safety, aiming for zero accidental injuries. Revenue impact. While not expected to be super material in 2026, robotaxi revenue is projected to be significant in 2027. Customer cars. Unsupervised FSD is, probably, expected to reach customer cars in the fourth quarter of 2026, with gradual, geography-specific rollouts based on confirmed safety. Hardware 3 limitations. Hardware 3 cars will not be capable of unsupervised FSD due to insufficient memory bandwidth. Tesla is offering discounted trade-ins for Hardware 4 upgrades and exploring microfactories for computer and camera replacements. AI-5 chip. AI-5 is not immediately needed in vehicles for unsupervised FSD due to AI Force capabilities. It will be used in Optimus and the data center. AI-4 Plus upgrade. An upgrade to AI-4 hardware, AI 4.1 or AI-4 Plus, with increased RAM, compute, and memory bandwidth is expected to enter production mid-2027. European expansion. Supervised FSD is moving to Brussels for EU review in May. EU-wide approval is expected later in Q2, with a hope for approval in China by Q3. Robotaxi expansion in Europe is a longer-term prospect, dependent on regulatory approvals. Safety data. Tesla is increasing its QA fleet and using customer fleet data for metrics. They track all relevant safety metrics and emphasize zero incidents to date. Convenience issues, such as vehicles getting stuck or hesitant, are the primary limitations for wider deployment, rather than direct safety issues. Camera visibility. Stricter measures for camera visibility have been implemented, and FSD will not be available if camera visibility is impaired. Significant risk factors. Capital expenditures and free cash flow. The massive increase in CapEx for 2026 and beyond will likely result in negative free cash flow for the remainder of the year, which could be a concern for investors. Production scaling challenges. The ramp-up of new products like Cybercab, semi-truck, and especially Optimus, involves entirely new supply chains and manufacturing processes, leading to inherent uncertainties and the possibility of slower than expected initial production. Technological hurdles for AI and FSD. While progress is rapid, achieving true unsupervised FSD and scaling robotaxi operations globally depend on overcoming complex technological challenges and rigorous validation. Regulatory approvals. Expansion of FSD and robotaxi services, especially internationally, is heavily reliant on obtaining regulatory approvals, which can be unpredictable. Competition. Increased competition in EV and energy storage markets is noted as a factor that could impact margins. Tariffs and interest rates. Both continue to add to automotive costs and can impact auto margins. Sustained high interest rates increased the cost of interest rate subventions. Supply chain constraints. Battery pack capacity is identified as a current limiter on growth. Hardware limitations. The inability of Hardware 3 cars to achieve unsupervised FSD necessitates costly upgrades for a significant portion of the existing fleet. Highlights. Strong auto demand recovery. Resurgence in demand in EMEA and growth in APAC and the US are positive signs. Highest Q1 order backlog in over 2 years indicates robust future demand. Improved auto margins. Sequential improvement in auto margins, even before considering one-time benefits. Significant progress in AI and FSD technology. Version 14.3 as a major architectural update, pipeline of improvements, and AI chip development, AI 5. Optimus potential. Reiteration of Optimus as a potentially revolutionary and game-changing product. Cybercab and semi-truck production launch marks the beginning of new product cycles. Energy storage business strength, high gross margins, and robust order backlog. FSD adoption growth, nearly 1.3 million paid customers, with subscription growth outpacing upfront purchases. European FSD approvals. Progress in the Netherlands, with broader EU approval expected. Technological advancements in chip design. Early AI 5 tapeout and plans for AI 6 and Dojo 3. Terafab Research Fab. Plan to build a research chip fab at Giga, Texas to explore fundamental chip manufacturing technologies. Successful FSD subscription metrics. Decreasing churn and increased customer driving duration indicate product satisfaction. Optimus Local Intelligence. Emphasis on robust local intelligence for the robot, allowing independent operation. Battery pack capacity efforts. Active work to resolve battery pack capacity limitations. Lowlights. Negative free cash flow expected. Due to substantial CapEx investment, negative FCF is anticipated for the remainder of 2026. Hardware 3 limitations for FSD. Inability of older hardware to support unsupervised FSD requires significant upgrades for many customers. Energy storage sequential decline. Deployments in energy storage saw a sequential decline in Q1. Normalized margin compression in energy, expected due to increasing competition and tariffs. Slow initial production ramp-up for new products. Cybercab, semi-truck, and Optimus are expected to have slow initial production ramps. Uncertainty of regulatory approvals. The pace and extent of FSD and robotaxi expansion are dependent on regulatory bodies. Dependence on supplier technology for chip production. Midterm, while Terafab is a long-term solution, midterm reliance on existing chip suppliers remains. Most important statements from CEO Elon Musk. We're going to be substantially increasing our investments in the future, so we should expect to see a very significant increase in capital expenditures, but I think well justified for a substantially increased future revenue stream. This sets the tone for 2026 as a major investment year for future growth. Optimus will be our biggest product, not just Tesla's biggest product ever, but probably the biggest product ever. This underscores the company's immense belief in the potential of their humanoid robot. When you have a new product with a completely new supply chain, new everything, it's always a stretched out S-curve. So you should expect that initial production of Cybercab and Semi will be very slow, but then ramping up and going kind of exponential towards the end of the year and certainly next year. This manages expectations for the initial rollout of new hardware. I think we're going to want to finish writing that software, validate it, and release it before going to very large-scale unsupervised FSD. This highlights the company's commitment to safety and validation before mass deployment of unsupervised FSD. Terafab is not a mechanism to generate leverage over our chip suppliers. It's literally because we don't see a path to having enough efficient quantity of AI chips down the road. This clarifies the strategic importance of internal chip manufacturing for future AI needs. Long term, the only manually driven car will be the new Tesla Roadster. This indicates a significant shift towards an all-autonomous vehicle future for Tesla. Most important statements from CFO Vaibhav Taneja. Auto margins, excluding credits, improved sequentially from 17.9% to 19.2%. Note that we have had certain one-time benefits from warranty true-downs around $230 million and some relief on tariffs. This provides specific figures for auto margin improvement and outlines contributing factors, including one-time benefits. Our biggest limiter continues to be our battery pack capacity, and we are actively working on resolving that. This identifies a key constraint on production growth. If interest rates continue to rise, our cost of subvention will continue to impact auto margins. This highlights a potential headwind for auto margins. With all this in mind, we have evolved our vehicle sales strategy, where we now emphasize FSD as a product and vehicle as only the delivery mechanism. This signifies a strategic shift in how Tesla views and sells its vehicles. As Elon mentioned, we are in a very big capital investment phase, which is going to start now and will last a couple of years. So based on that, our current expectation for 2026 is over $25 billion of CapEx. This quantifies the significant upcoming investment and its duration. While this may seem like a lot and will have the impact of negative free cash flow for the rest of the year, we believe this is the right strategy to position the company for the next era. This acknowledges the short-term financial impact of the investment strategy while emphasizing its long-term benefits. We have not realized any benefit from the recent Supreme Court ruling on IEEPA tariffs, as there is still a lot of uncertainty around the final outcome. This provides an update on the impact of potential tariff changes. This summary aims to provide a comprehensive yet concise overview of Tesla's Q1 2026 earnings call, suitable for reading aloud.